Welcome to the Daily Update, where I'll go over the action in the market for Thursday, July 13th, and then we'll see how things look for Friday, July 14th. We had another up day. The S&P was able to get above 4,500. We're starting to look even more extreme positive right now. We're also getting closer to the middle part of July, where historically we have seen some weakness. But our charts are still looking positive, albeit a little extended. The intermediate term is showing improvement, and of course the long term is also improving as well. The PPI was well received. Now the scenario is coming back to more of the Goldilocks type of approach to looking at things. So let's go back and talk about what happened. Right at the open, we had a gap higher above R1 at 44.86, and then we also climbed above R2 at 4,500, and we were able to close above that level. The daily spread from the high to the low is pretty small, so on Friday, the R and S levels are going to be pretty close to each other. As the day went on, prices moved higher above R2, and we closed a bit off of the high. We were up 0.85% on below average volume. The technicals are positive, but looking a little extended. We're also seasonally coming into a weaker time of the year. But it's all about inflation and interest rates, and now we're going back to the growth concern is looking like it's under control. What are some comments that we can make? The S&P did close above 4,500. The Dow was a real laggard in Thursday's session. It was up, but not by very much. And then this current scenario, this belief that the economy can avoid a hard landing, which means it will have a soft landing or something like that. And they also are starting to believe that the Fed is close to being done raising interest rates. Now, this can always change. We can always go back to this more doomy scenario at any time. This is just how the market is viewing things right now. The S&P and the NASDAQ, yesterday they set a 52-week high. Well, in today's session, they also set a new 52-week intraday high. The mega caps as well as the broad market showed strength. We're seeing more broad participation as the market's going up. But our list is getting longer. On the short-term basis, being extreme positive, we have the CMB composite. That's a new addition to the list. The moving average study, the CCI 14 and 20, the Stochc RSI, Williams percent R, standard deviations chart, the stochastics. Another one that's new is the RSI 9 and the Boom 20. Intermediate term, we're also getting a little extended with the balance of power. Our oscillators are improving, but still showing that negative divergence. The Sean trend meter, the BPI for the S&P, as well as the NASDAQ 100. A new addition is the percent B indicator, the RSI based on 14 periods, and the Boom indicator based on 50. Longer term, we're keeping an eye on that moving average study as well. The dollar was down. It actually dropped below 100 for part of the day, but closed back above 100, and interest rates were down. Both of these together are giving good support to stocks going higher. We still have the yield curves that remain inverted that we've been watching. Sentiment is up at 80 now. It ticked up from 79, and we are extreme positive. And our trend is positive. The green line's going up. The ADX has been able to cross back above its moving average. Both of them are above 20, but they're getting back up now to 40. Our bias and our momentum continue to be positive. The economic reports that came out, the PPI came in up 0.1% month over month, less than the 0.2% that they had expected. Last time it came in down 0.4%. When you take out food and energy, we were up 0.1% month over month, less than the 0.2% that they had expected. Last time it came in at being up 0.1%. Year over year, the PPI is up 0.1%, and the core PPI is up 2.4%. Weekly jobless claims came in weaker than expected at 237,000. They expected 10,000 more than that. Continuing claims continue to decline. Looking at some charts, here's the final PPI reading, showing the total is the blue line, how it's been coming down, almost getting down to this 0 point now, where the core, when you take out food and energy, it's also declining but continues to be positive. The final demand PPI, year over year, we're seeing a decline based on goods, and we're also seeing a slight decline based on services. The intermediate goods PPI, both processed and unprocessed goods are continuing to decline, and in fact, they're starting to go negative. Here's a look at a chart that I have. You have a little bit of a definition from Investopedia up on top, showing over 12 months how we're now starting to go negative with PPI. The rate of change was up just a little bit, but pretty much unchanged. Then when we look at the core PPI, which takes out food and energy, here's the rate of change going back a year, how it's declining, and then the month-over-month change is down on the bottom. Then we also had the federal budget, which looks at the trailing 12 months and how it is also declining. And the federal receipts and outlays, where we see the receipts going down and the outlays going up, producing a little bit more of a deficit. Weekly jobless claims also declined and were below a declining 4-week moving average. Continuing claims were up just a little bit, but overall we continued to decline. This is when we look at all of them together. The initial jobless claims are red, where they're declining. Continuing claims are also declining. And then a week ago, we had the unemployment rate, which is ticking down just slightly. Looking at some IsabelNet.com blog charts, we're showing sentiment is still extreme positive, which is lining up with our other indicators that we look at. Also looking at the ISM Manufacturing and Services Survey data, we're starting to turn back up when we have a composite between the two, but the red line is the Purchasing Managers Index, which means that we are declining, and so we're seeing a bit of a disconnect between these two. When we look at global fund flows, we're seeing bonds and cash really going up. Equities are going up after they had been declining. The first half of July is strong for stocks, and we're getting up into that middle part now where we tend to see some weakness and then possibly a little bit of strength going into the end of the month. We have some other data that we look at from Stock Traders Almanac that suggests we see a little weakness going into the end of the month. Looking at the earnings growth year over year, this is from Goldman Sachs. They're still expecting us to be negative in the quarter that we're in right now, a little bit negative in the third quarter, and then turning more positive going forward from here. Then the exposure to oil starting to come down. It really didn't go up the way folks were talking about when OPEC was announcing less of a supply on the market, and so people are getting out of that now. They asked the question, are you likely to increase or decrease your bond portfolio? Folks are starting to decrease their bond portfolio overall. We look at flexible prices. That's the blue line where it's coming down and turning down a little bit more, and we're getting down closer to this black line. These are things that can change pretty fast. The sticky prices, they're coming down a little bit slower. They don't change as much, but they are still declining. We look at the debt allocation. Right now it's at 21%. These are the folks that are in bonds. We look at fund flows. Most money is going into tech. Most money is coming out of energy. A couple of Twitter charts. This is the misery index. The higher this index goes, the more misery people are experiencing. You take the year-over-year CPI, and then you add the unemployment rate to that. Well, the CPI has been coming down, and the unemployment rate is still very low, so the misery index is really continuing to decline. Another chart that was on Twitter that put out by sentimenttrader.com, which is a fabulous service. It says investors love stocks over bonds to the greatest extent in 24 years. This is a very unique website, and he comes up with a lot of interesting ways to look at the market. These are interesting things to know, but we don't necessarily use them to make decisions, where it's really high right now with the optimism with stocks. Looking at our charts and analysis. Here we show we had the gap higher above R1. We came almost up to R2. Eventually we broke above that and just kept going higher as the day went on, and then saw a little bit of a pullback going into the close. Here's the intraday chart where the initial overnight session was positive. We really started to go more positive in the pre-market session. Then we went higher during the day, little bit of weakness, and we're down just slightly in the initial overnight session. We're starting to see where growth and value are performing about the same now. Growth had a pretty good day on Thursday. And here's the closing basis where growth was up 1%, value was up 0.57% with the large caps. It underperformed with the mid caps, but outperformed with the small caps. Here's our growth to value ratio for the S&P. We're above the dashed line, so we were positive, but we did see a little bit of weakness going into the close. So this chart is showing some improvement. Looking at sentiment, still no fear right now based on our Ulcer Index. We see a decline with the VIX on the line chart as well as the bar chart. Volatility has stayed about the same and actually picked up just a little bit. And we're also watching this. We're starting to slowly come back down with our VIX to S&P 500 correlation. We're still above the dashed line, and now we're wondering, is this going to be something positive or negative for the market? The equity put-call ratio continues to decline as we're going higher. The longer-term equity put-call ratio continues to be positive. The MOVE index, with the upward movement in bonds, we saw volatility really drop. Because stocks were up, we also saw the VIX drop, and the correlation is getting back to being very strong. The other fear gauge that we look at is also going back to showing a decrease in fear, and this other fear gauge also continues to decrease. Folks are still favoring stocks over bonds. We had the latest reading from the American Association of Individual Investors. They ticked down just slightly because a week ago things were a little bit weird. They didn't like that, so they reacted to that, but they're still positive overall. Our advanced decline line study, seeing some nice movement based on price that we're going higher, and we're breaking out finally based on volume. We're seeing a nice advance in the new highs. It's not really rolling over our 5 period yet, but it is starting to turn up our 10 period differential. The advanced decline ratio above 0 and advancing and not extreme. Accumulation distribution is also positive. We're showing a lot of improvement with the cumulative advanced decline line for the NYSE as well as our regular advanced decline line. We're actually breaking out when we look back at other highs. This NYSE advanced decline line is still above this trend line. We're seeing a lot of improvement with the common stock based on price and volume, but we still have not really been able to break out above this previous high based on price. We're lagging a little bit based on volume. Looking at our advanced decline line studies, pretty much more positive across the board with the NYSE, S&P, mid caps, and small caps. Our trend, we're starting to get a little extreme with our green line here, but that's on top and we default to positive. The ADX is crossing back above the moving average. The red line is decreasing. So things are positive. We just want to be aware that this is giving us a pretty high reading right now. We're seeing that same basic thing with the shorter term ADX. The green line is extreme, turning back up, red line is declining. But volume picked up just a little bit, but continues to be below average. Looking at our short-term charts, we're finally starting to break out. We might have some upper resistance where we're at right now. We're coming back and testing previous highs. And if we continue to go up, we might bump into this trend line where you can see at the bottom where volume continues to be below average. The CMB Composite Index just barely starting to get extreme positive. We're breaking out above the double and triple exponential moving averages based on 20 periods, so that is showing improvement. The 20-period exponential moving average is extreme. The 50 is extreme. We're seeing improvement with the 200. The Stochc RSI is extreme positive. The Williams percent R also extreme positive. The CCI 14 and the CCI 20. All of these are extreme positive. They could go higher. They could camp up in this area for a while. We just want to be aware of this. Our short-term stochastics are back to extreme positive. Intermediate term, extreme positive. We actually turned down a little bit with our longer-term stochastics, but we're still in extreme positive territory. The boom indicator, we're looking at just barely extreme based on 20 periods and 50 periods and showing improvement with the 200-period boom indicator. What this tries to measure is how far away are we getting from various moving averages. The further away we get, the higher this reading is down below, and when we get too far away, we have a tendency to come back. The force index is positive and above 0. Then looking at some intermediate term charts, the balance of power continues to be extreme positive. It ticked down slightly. We're above the 50-period double and triple exponential moving averages. It had acted as support with the double exponential moving average, and now we're breaking above the triple exponential moving average. The go-no-go system is turned back to darker blue. That's positive. And we're starting to turn up with our highest high value, and it's starting to reflect what's actually happening in price, which suggests good upward momentum. The TTM squeeze looking a little better. Darker shade of blue starting to turn back up. We're into the third standard deviation now, meaning that we've gone up pretty far, pretty fast. The Bollinger Bands were also outside of the upper band, and we also see this with our percent B indicator, measuring that we're extreme positive. The ease of movement after coming down to 0 is now starting to bounce back up. The PPO studies are still positive across the board. The Erin indicator is starting to go back up with our oscillator as the buyers are pegged to the top. That means they're in control, and we're seeing a decrease in sellers. The S&P McClellan oscillator is just barely starting to get extreme positive. Now it has more room to run to the upside. We just want to be aware of this. Our summation index based on price and volume continue to advance. The NYSE McClellan oscillator above zero and advancing. The NYSE summation index showing improvement based on price and volume. The Swenlin trading oscillator turning back up based on price and volume, and both are above zero. The PMO starting to turn back positive. We're going positive based on price, and we're turning up based on volume. The PMO study, we were pretty much flat with the percent of PMOs that are rising, showing an improvement with the buy signals, and really showing some improvement with the PMOs that are above zero, and just a little bit under being extreme positive. The Elder Impulse system for the S&P remains positive with a green bar. The parabolic SAR is also positive with the dots underneath. The slope oscillator is starting to turn back up, and that's looking more positive. This is usually our touchiest oscillator of all, so that's why I have a separate chart just of that. I also like to look at the MACD because so many people use that. That's also starting to turn more positive. We're still seeing this negative divergence when we look at our oscillators, but they are starting to show some improvement. The Sean trend meter is getting extreme positive, and the bullish percent index is getting extreme positive, but still has more room to go up if we continue to advance. The NYSE bullish percent index is above 50 and advancing and showing improvement. The chicken money flow, this is just a little bit of a concern. On an up day, it's going down. This indicator tries to measure institutional buying and selling, and when this is going down, that might indicate we're seeing some selling into strength. The chicken oscillator also turned back up just a little bit, but it's been real choppy as of late. The money flow index advanced slightly and is above 50. That's positive. The ultimate oscillator also a little choppy, above 50, but advancing. The vortex is crossed back above this one level with the green line on top, so that's positive. The RSI based on 14 and 9 periods still showing this negative divergence, but starting to improve nonetheless. On balance volume continues to be positive. We're coming back to another Copic curve signal. The black line is starting to cross above the red line. We're showing a lot of improvement with our 200-day simple moving average study. We're coming back possibly to this previous high. We're also showing improvement with the 50-period study. We also could be coming back to this previous high. Here's another look at that same chart. Sometimes looking at the same thing in slightly different ways gives you some additional insight. I only have one chart for the Fibonacci and line study. It's our quadrant lines. We're hitting upper resistance right now. When we go back and test previous highs, we'll see if we're able to break through that. And then our different charts. The Heiken Ashi is positive, the Kegi is positive and going higher. The Renko is also going higher, and the 3-line break continues to be positive. Our different indexes, we're seeing a lot of improvement with the equal weight index, but it still is underperforming the S&P. We're ticking up just a little bit with this ratio as the mega caps did a little bit better on Thursday. Looking at Dow theory, we're starting to break out a little bit with Dow. We were down a little bit with the transports. We're still above this breakout point, and we did see some improvement with the utilities. When we look at the transports, the S&P 500, the ratio is going down, but we're going up overall. We want to keep an eye on this one. The relationship between the S&P and the transports is improving slightly, but not as strong as it usually is. And the transports and the Dow are pretty much performing about the same. Just to look at new Dow theory, where we take the S&P instead of the Dow on top, it's showing a lot of improvement. And instead of looking at the transports or the railroad stocks, this is also showing a lot of improvement. So these are converging with each other or providing a confirmation. The discretionary staples study. We saw a little bit of a decline with discretionary, a little bit of an advance with the staples, so our ratio turned over just a bit, but discretionary is outperforming staples. The Dow is still pretty much in a sideways trend. We'll have to see if this will be able to break out of these recent highs. The diamonds remain positive for the Dow. The Nasdaq also coming up to this R1 level. We broke above previous prices, which is also a 61.8% retracement level, but are we going to start running into trouble when we hit this R1 level? Then we do have the Fibonacci chart showing that we broke above the 61.8% retracement level. We're showing a little bit of improvement with the cumulative new highs and new lows for the NASDAQ, but they continue to decline overall. When we subtract the new lows from the new highs, we are still positive. We're also breaking out above this previous high for the NASDAQ 100, but we're right at resistance. The Elder Impulse system for the Qs remains positive, and we're above the 61.8% retracement level with the NASDAQ 100. The next level, if we even try to test it, would be the all-time high. The BPI for the NASDAQ 100 is now getting more extreme positive. We'll be watching this to see if it starts to turn down. We thought this other signal might have been some kind of a major signal, but it's pretty much recouped that now. The higher this goes, the more extreme it is, and the more likely it is that it could suggest that we're topping out, at least in the short to intermediate term. The Qs to the Dow show that the Qs are really outperforming. Their relationship is getting a little bit stronger. This is a new chart. We're measuring the Qs to the TLT, which is the long-term bond ETF. They had been going in opposite directions. That relationship is starting to improve slightly, and there's a really wide spread between the two. They tend to go in the same basic direction because you have the Qs, which are tech, and they're heavily sensitive to interest rates. So if interest rates are going up or down, the Qs are typically doing the same thing. Now we're seeing a real disconnect as of late. The small cap index was also up on the day and starting to break above this conglomeration of prices. We haven't come back up to give a golden cross based on this index yet. Where we're looking a little more positive with the Russell 2000 small caps, we're starting to get extreme positive with the RSI. We've been able to break out above resistance. We have a recent golden cross, and the MACD is also back to being positive. The small caps for the Elder Impulse system continue to be positive. The small cap ratio to the S&P ticked down just a little bit and continues to underperform the S&P. The small caps, when we measure growth versus value, did decline a little bit, still in an uptrend, but more or less chopping sideways. The mid caps also coming up to what could be resistance at this R1 level, but the Elder Impulse system for the mid caps remains positive with a green bar. We're still showing strength when we compare mid cap growth to mid cap value. We are in an overall uptrend. Looking at the home builders, they had a really good day. Their ETF really broke out. The S&P was up. The ratio is continuing to go higher, and their relationship is very strong between the two. The dollar did decline on a closing basis. Intraday, we did drop below 100, which is not shown on this chart, but we were able to get back above 100. We're also keeping an eye on the FANG index because we're coming back up and testing this previous all-time high at about the 8,000 level. Will this be a problem if we continue to go up to this level? Looking at the broad range, the S&P 1500 against shorter-term bonds, stocks are really outperforming. Then the broad market with further out bonds also outperforming. The tech sector continues to outperform bonds. And the S&P is also outperforming bonds, suggesting that we may have a soft landing. Home construction continues to really break out when looking at bonds. Value is showing a lot of weakness, where growth is showing a lot of strength and really improving. Keeping an eye on the financial sector, we were up on the day and continue to be above the 50 and 200-day moving averages. But when we compare the financial sector to the S&P, it turned down and we're in an overall downtrend. The regional banking ETF did really do well on a one-day basis, but continues to be in a downtrend when we compare it to the financial sector. Keeping an eye on bonds, after they were really spiking up with yields are now starting to come back down, where price fell below the 200-day moving average, and now price is starting to go back up. We could be getting ready to bump into the 50-period moving average. Looking at the value to growth ratio, that's the black line. And then we compare that with the 10-year Treasury yield, where it's really been coming down. The correlation between the two is starting to get stronger, where they had been getting far apart from each other. Then we're also looking at cash with the 3 to 7 year bond ETF. That's really coming down, but still in an overall uptrend. We want to see this continue to fall if the market's more comfortable about interest rates. We're still above this 2007 level with the 3-month yield. If it falls and drops below this level, we're wondering if that's going to be some kind of a warning sign. Our longer term charts, we're still positive with the special K on the daily chart. I don't have the chart, but we're still negative on the weekly chart. We're also seeing a little bit of an extreme positive reading with the 150 and 200-day simple moving average studies. Longer term, this is a weekly chart where we're starting to barely break through this resistance. Not enough to really convince us that this resistance is not real, but we are at least giving that a good challenge. We're also seeing that same thing with the NASDAQ 100, breaking out slightly above this resistance level. When we look at the ratio between the NASDAQ 100 and the Dow, we're also continuing to climb. When this happened before, that was the end of the dot-com boom, which led to the dot-com bust. We're wondering, is this ratio going to continue to go up and maybe prove things wrong this time? An update of our possible positive scenarios. We saw the Qs outperforming the S&P, saw some improvement with discretionary to the S&P. Large cap growth outperformed large cap value. When we look at our growth to value ratios, looking better with the large caps, declining a bit with the mid caps, and pretty much flat with the small caps. The S&P to utilities ratio declined a little bit, but is going up overall. That's been giving some good support to the S&P. When we look at the 5-period simple moving average of the high minus lows for the Amex, NASDAQ, and NYSE, we continue to be above zero. The 10-day average of the highs minus the lows for the S&P, we dropped a little bit, but we're still in this extreme positive territory, suggesting for right now anyway that momentum is strong. If we really start to drop here, that might mean that we're in an overbought condition that's starting to pull back. This is still a concern though. The S&P growth to value ratio still in an uptrend but continues to decline. The 50-period exponential moving average of the new highs minus the new lows continues to advance, and our indicator, that's the black line, is continuing to advance. The red line here is the same red line that you see on the previous chart, and that is also going higher. This is a chart I haven't shown for a while because the S&P and the 2-year yield have been going in the same direction, and they're still kind of doing that. We spiked up and are starting to come back down. We'll have to see if that relationship shifts and watch the intermarket analysis video over the weekend to see where we're at with that. But if this continues to fall, that could give some short to intermediate term support to the S&P. The staples to S&P 500 ratio continues to fall, and that's also been giving good support to the S&P 500. So what's our outlook for Friday? JP Morgan, Wells Fargo, and Citibank will report their earnings, so that's going to be pretty influential. The technicals are positive, and we're becoming even a little bit more overbought, where right now it looks like we're showing good momentum. That could change at any time. The economic reports coming out will get import and export prices, as well as the preliminary reading on consumer sentiment. Then we're keeping an eye on the geopolitical events, but the market is fixated on inflation and interest rates. Here's the updated economic calendar where we just have Friday to go. We have completed all of the Fed speak for this week. Looking at the Stock Traders Almanac statistics for July 14th, we are positive across the board. We're also looking positive on the 9th trading day of the month. We still have another day or so, which could be Friday or Monday's session, before we start to top out and see a little bit of weakness coming into the market. Now, this is different than the previous chart where we're seeing a little bit more weakness going into the latter part of July. We're also watching this. We're coming up to the middle part of July for the NASDAQ where it tends to perform well, and then we see some weakness after that, historically. Now, we can totally blow this out of the water. We use this as a guide just to give us an idea of what has already happened in the past. Our scenarios, not going with the down one right now, even though we're slightly overbought, and that could shift and send things lower at any time, but it hasn't done that yet. So we're still going with the positive trend because our technicals are positive, and as of right now, we're showing pretty good momentum. We're not going with the sideways trend because the ADX and the moving average are both above 20. They are looking a little extreme, but for right now, we can read that more as being positive. So our warning signs, the longer-term trend signals, they still might be signaling a top. We don't have to hit that mark just exactly, and plus I drew that line, so there might be some mistakes in that. We just want to be aware of that and see if we can leave this in the dust, or is this going to prevent us from going higher and start to turn back lower. Our oscillators continue to show negative divergences, but they are improving. The VIX is still showing that there's not a lot of fear. The other chart that we look at, the ratio between the S&P and the VIX, is starting to come down slightly, but we don't know if that's actually topped out yet. The cumulative new highs, new lows, although they're showing a little bit of improvement, are still showing weakness overall. The 3-month yield is still above where it was at back in 2007. S&P growth is showing weakness even though it's still in an uptrend. And then earnings season is going to start to be underway. Positive signs. We still have seasonality and setups that remain in the background. Our daily special K chart is positive. Our weekly chart continues to be negative. The longer-term equity put-call ratio continues to be positive. The S&P is still above that downtrend channel upper line, and we're getting further away from it now. We're still in a risk-on posture. The transports are showing some improvement, but they really didn't participate in Thursday's rally. Lower price levels so far have been providing support. The S&P is outperforming utilities. The NASDAQ is above that 61.8% retracement level, and the NASDAQ 100 is now broke above that previous high, and the Staples to S&P 500 ratio is declining, giving good support to the S&P. The small cap Russell index and the mid caps generated a recent golden cross. We're getting better with the S&P small cap index, but we have not generated a golden cross yet. Small and mid cap growth continue to be positive, with mid cap growth showing most of the strength, and the Copic curve is now in the process of generating a buy signal. Our conclusion: the S&P remains positive, but every time we go up, it's becoming more and more overbought. In the short term, we're pretty much becoming overbought, even though we're positive, and our list is getting longer. Intermediate term, we're also showing some more indications that we're overbought, but we might want to ride this for a while, suggesting that there's good momentum, but that could always change. Longer term, we still remain positive. Thank you. I hope you have a really good day, and I will talk to you in the next video.